So on December 1st, 2025, something huge happened. The Federal Reserve quietly flipped a massive switch on the entire US economy. They've gone from trying to remove money to turning the money printer right back on. And trust me, this is a change that's going to impact every single one of us.
And how do we know the printer is back on? Well, because just one day after they flipped that switch, on December 2nd, the Fed pumped a jaw-dropping $13.5 billion into the economy. That is the second largest single-day injection we've seen since the pandemic. And folks, this is just getting started.
Okay, so why should you care about these giant abstract numbers? It's simple, because this new policy directly attacks the value of your salary and your savings. Every single dollar you work for is now in a race against that money printer.
So what does this actually mean when we say the Fed hit the reset button? Well, to really get it, we first have to understand the policy they just threw out the window.
For the last couple of years, the Fed's been doing something called quantitative tightening, or QT. This was their big plan to fight the crazy inflation we've all been feeling. They were literally pulling money out of the system, but on December 1st, 2025, they stopped. And that's a huge signal that they're now way more worried about a slowing economy than they are about rising prices.
Now, to really understand why this U-turn is so dramatic, you have to look at the economic roller coaster we've all been on. It's really a story of two completely opposite forces.
On one side, you've got quantitative easing, QE. Just think of this as the gas pedal. The Fed prints money to get the economy going. On the other side is quantitative tightening, QT, which is the brake pedal. They pull money out to cool things down. And for the past few years, the Fed has just been slamming its foot from one pedal to the other.
And here's pretty much how it all played out. Back in 2020, to fight the pandemic shutdown, the Fed hit the gas with massive QE. That's what funded stimulus checks and kicked off a wild stock market rally. But of course, the consequence we saw in 2021 was inflation just soaring. So in 2022, they slammed on the brakes with QT to fight it. And that brings us right here to today, where they've taken their foot off the brake and are getting ready to hit the gas again.
But here's the thing. This time, it's different. There is a massive, game-changing factor in our economy that just didn't exist in the same way during the last round of money printing back in 2020.
You have to remember, the last time the Fed was pumping this much cash into the system, AI, as we know it today, just wasn't a thing. Now it is everywhere, and that could fundamentally change where all this new money ends up going. And this gets to the heart of a huge concern. See, the Fed is hoping this new money creates jobs, but what if companies just take that money and invest in AI to cut down on their human workforce? We could be walking into a situation where corporate profits go through the roof, but jobs and wages for everyday people completely flatline. So, let's bring this all back down to what really matters, your own wallet. What does a new era of money printing actually do to the money you have sitting in the bank right now?
It really boils down to this. When more dollars are created, the value of each dollar you already have goes down. It's just simple supply and demand. The more dollars there are floating around, the less each one can buy. You're basically in a race to grow your money faster than it's being devalued.
Here's a super simple example of how that works. Let's say your savings account is earning you 1% interest. Well, if inflation is running at 3%, you're not actually growing your money at all. In terms of what you can actually buy, you've lost 2% of your wealth in just 1 year.
And it's the exact same story with your salary. You might get a 2% raise at work and feel like, hey, I'm getting ahead. But if the cost of everything, your food, your gas, your rent, goes up by 3%, then that raise just got totally wiped out and then some. You're actually poorer, even though your paycheck is bigger. That is the hidden tax of inflation.
So if savers and people earning a salary are stuck in this race against a devaluing dollar, who actually wins when all this new money gets pumped into the system? Well, the answer is pretty clear. The system is set up to benefit the investor.
Let's just follow the money for a second. More dollars are created. That leads to people spending more. This, in turn, boosts the sales and profits of businesses. And where do all those extra profits go? They increase the value of the company itself, pushing up the price of things like stocks, which directly benefits whoever owns those assets. So here's the real kicker. When a company's profits shoot up because of all this new spending, the workers get their salary, maybe a small raise if they're lucky, but the owners and the investors, they get to keep all of the extra profit. This is exactly why Wall Street gets so excited when they hear the money printer is warming up again.
And that really leaves us with a final, tough question that gets right to the heart of this entire economic shift. When the very currency you're paid in is being systematically devalued, does it make more sense to save that currency, or does it make more sense to own the very assets that are designed to capture the value from all that new money being created?